We gon' make it. 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 Mm-hmm. Hey, what's up, people? It's your boy, Mr. Trader Dial, on this lovely Thursday morning. Before we get into the topic of the day of dividend stocks, opening up that other income stream, I want to get into a couple picks of the day in my little watch list. There are a couple small cappers. Um, they both gapping up crazy. The first one is IZEA, IZEA. They actually gapped up 30%. They just regained compliance with NASDAQ and they got a positive outlook on their books. So that's, the pre-market outlook on them is great. They actually gapped up 24%. The price was 80 to 80 cent. Now they're up to $1.38. That was a 24 cent, which was a 22% gap up. So yeah, I went on that. I took a market order at $1.45. Even though it gapped up 24 cents, I want to see some more legs before I come in. I never do market orders, always limit orders. The other order is KTOV, KTOV. That was another good one. They actually gapped up. They're an Israeli company, but they have some shares. They have a deal for $35 million. They sold, I'm sorry, $38 million of shares, and the deal closes today on the 25th. So all that money's gonna come on the books, and that's why they're gapping actually too. So that's the two stocks that I chose today. Actually, I have more, but those are the smaller caps. One was $1.05, one was $1.39. But they actually was 80 cent to 79 cent, and they both gapped up in the morning. As I say, when you see a stock that gaps plus the news, that's always a good stock that you want to watch for the day. Well, gap, news, new products in the pipeline, and the volume. That's the criteria I set for mine. So whatever criteria you set for yourself, you always want to stick to that. Because therefore, when you stick to your criteria, you have a better success of you have a better chance of successful trades because you're not just reaching. You're actually doing a scientific. Now, I don't want to say scientific, more of a technical approach instead of a guessing approach. All right. So we're gonna go to the next topic now. We're gonna talk about the dividend stocks and how to get paid off of dividends and what are dividends. Okay, so our first photo is we're gonna come right. All right, so our first dividends. Let's talk about dividends. What are dividends? It's a portion of the company's profits that are paid regularly to the shareholders for holding the stock. Now you have two options to get paid: quarterly, 4 times a year, every 3 months, or monthly. So it depends on the company that pays monthly, some that pay quarterly, and you got the yield, which is the percentage of the stock price per share, and the dividends, which is the cash per share. So you want to look for a company to have a great yield. Now, see, again, all of this is part of fundamental analysis. You can find all of this on the company's on the financial sheets. When you click on financials, all this information come up. So, but as we see here, 81% of the S&P 500, that's like the S&P index. 81% of them pay dividends since 1926. Companies that have dividends represent half of the total market. That's pretty crazy. So half of the market from 1926, they pay dividends. 81% of the S&P. That's like 8 out of every 10 companies. They pay dividends in the S&P. So we go to the next screen. Did you see? Dividends is that's the source of income. So we're gonna get into the pros and cons of holding dividends. Well, how they work. All right, so as we see here, money paid out regularly by a company to the shareholders. It can be issued as cash, stocks, or property. So dividends aren't always cash. Sometimes they give you more stock. In rare instances, they give you property, but that's mostly if you're held like a lot of shares in a company, like a lot of shares to be a influential shareholder. All right, so why give it out? Investors, they like steady income. That makes people want to invest in your company. If they know that they can get a steady income, and get more dividends, they're gonna invest in your company because it brings more income. Um, Also, signs of a company's strength. Like again, if the company is strong enough to pay out its earnings on a monthly basis, that's a company that people want to invest in because it's a strong company. They have strong financials. You know, it's a company worth investing your money. So, what are the benefits? Again, you get cash out of the market and you avoid excessive trading fees because you're pretty much buying and holding. You're not day trading. But see, this is kind of an old thing because there's not too many trading fees nowadays. Like all kind of brokerages, they have commission fee trading. So the main benefit is you get cash out of the market. Like again, like I explained last night or yesterday on the previous podcast, the REIT and the dividend payout. I mean, the cash benefit for the REIT and the dividend is kind of the same. It's not the same beginning, but it has the same ending. Like so, as I told you, for a REIT, you get paid by two ways: capital appreciation, which means that you buy it at this price and it raises up, so your total investment gains. You know, it appreciates in value. Or when they're when the people that own property after REIT, whenever they pay their rent, that's how you get paid. But it's the same thing when you have a stock that own dividends. You either get paid by the dividends either quarterly or monthly. And you also when your investment and gains in capital appreciation. But the only thing about that is the only time you really get to realize that profit is when you sell that investment. But capital gains, you're probably never going to actually realize them. Because most people hold when they when they invest in a company for the dividends, it's like a long term thing. The only time you stop investing is the company starts showing sign of weakness, and your dividends, you know, the dividends amount drop or they lose value. That's when you will look to sell that company. Yeah. So the most important part, come off the screens. Well, no, actually, no. There's one more I want to show you. One more important thing I want to show you. Now, when you deal with dividends, there's four important dates. See, that's the thing with dividends. Like, all right, so most stocks, you just buy them and sell them, or buy them and hold them, or do what you want to do with them. As now, when you buy stock for the dividend, these dates are important because these dates determine if you get paid or not. You know, so you all right. So you got the announcement date. That's when the stock. That's when the company announces that they have the dividends, such and such. You have the ex dividend date. The stock drops by the amount of the dividend, which means that if you buy on or after the ex dividend date, you don't receive the dividends. So, which pretty much means, man, if you're looking to invest in the company, you need to know what the ex dividend date is if you want to participate in making profit off the dividends. Because it says here clearly, if you buy on or after the ex dividend date, you won't receive dividends. Matter of fact, the person that say if you bought on that date, the person that sold that stock on that date is actually going to receive the dividends. Likewise, on the record date, if you sell before the record date, you won't receive the dividends, which is the inverse of if you buy on the X date. So they're pretty much the same thing. They're just saying the topics are different. The X dividend date you have to own before you buy, which as the record date you have to own before you sell that date. Basically, those are the two most important. Well, actually, this is the most important date, the payout date, the date when you receive the dividends. Now, for every company, these four dates change. Like this is not a one size fit all throughout the whole market. No, this is more of a um however you want to approach it as it fits your schedule for each company. So it's not like every company gonna have the same date. So but yeah, I feel like when you invest in dividends, you need to know the ex dividend date because it would suck to buy 1,000 shares of such and such company to participate in the dividends, but you're after the date, and it's like wow, oh that was for nothing. And likewise, if you want to sell, likewise. So you want to know those dates, man. These are the four most important dates, and that pretty much is separates the dividends from like the average stock. Because when you buy stocks, you don't really need to know the dates or anything. Maybe like a IPO, that's the first date when it becomes public, the initial public offering. But other than that, you don't need to know any specific dates. Whereas, as we just saw in that screen share, when you buying the dividend, you need to know those four dates: the announcement date, which the company announces that they have dividends; the ex dividend date, which is the date you must own before you buy or you won't get paid; the record date, the date you must sell; and of course, the most important date is the payout date. And that's right there. Those are the four most important dates when you're looking to invest in the stock for the dividends. Now, the thing with dividend stocks, dividends they don't pay out. And okay, obviously, like it's the same as a REIT. Like I keep saying, the REIT and the dividend stocks, REIT stocks and dividend stocks have so much in common. It's the same thing. The amount that you receive from your dividends is tied to the amount that you invest in. So basically, you get in what you put out. So if you put out if you put in 5 shares, when they do the dividends, you're gonna get paid however many shares, um however much those dividends cost, you're gonna multiply that by 5, and that's gonna be your dividend. Now, most companies they don't pay crazy amount of dividends because you got to think they have millions of shareholders. They can't pay but so much to every shareholder. So the dividend amount is only gonna be maybe 25 cent maximum, sometimes 75 cent. And that's not a lot, but if you have a bunch of shares, again, it adds up. And so you want to combine the REITs with the dividend stocks. That's how you build a portfolio. That's how you build a safe portfolio too. Because again, most long-term investments, like I explained last night, when people say a recession-proof portfolio, they're not really saying that it's never going to go down. They're just saying it's gonna be less adverse to the bigger moves that maybe a traditional, like a tech portfolio in an economy like this, or a retail portfolio, something like that. Whereas, as we explained last night, warehouses, data centers, things like that, they're always going to be in use in a recession. So is the dividend stock for safer companies that got bigger names. They got they're known as safer companies than they're like older companies. Those are companies that you want to look for when you invest in the dividends because again, they're long term investments. So they're going to be a safer investment than maybe a newer company. And like I say, when the company pays out its investments, pays out its profits to its shareholders, that's the signs of a strong company. But again, like it's a trade off. Same thing as a REIT. Like the biggest disadvantage for a dividend company is that you might not see as much capital gains because again, companies when they make profit, they reinvest it back into the company, which in turn makes the stock rises up because they're doing new products or they're doing newer things. Whereas when a company pays out its profit, they're not really putting the money back into the company. They're giving it to its shareholders. So you might not see as much capital gains as you would see as a company that reinvests back into itself. But again, that's a good trade off because you're getting paid by the company. You just got to have enough shares. So you can go to like Google, put in companies that pay monthly dividends. Man, I'm doing a bunch of trading this morning. This forex market, the forex market is on point this morning. Euro's going down, the dollar's going up. But yeah. So you can Google looking companies that pay on a monthly or pay on a quarterly. That's the schedule when they pay the dividends, and then it'll tell you the dividend amount. That's the yield percent of the stock price, things like that. All this is you will see this is part of the fundamental analysis. Like I say, me as a day trader, I really don't look for the dividends, but I'm trying something new in this economy. We're gonna look for a safer portfolio that can handle some adverse and handle some movements against it. So as we explained yesterday, REITs, that's one income stream. Dividends, that's another income stream. You combine those two, like again, you get paid on the investment that you put in. So you start small, you combine those two. You can start like a nice little $30 a month as being paid to you, but just by holding 40, 50, it doesn't matter. You got to start somewhere. Then you start combining that with the other streams that we're going to follow through the next couple of days. You get up to about $1,000 a month of extra income that you didn't work for. And that's a good amount. income that you're not working for, income that you're not necessarily counting on. That's all extra income. That's 12 a year. That's pretty good for extra income that you're not really counting on, you're not trying to work on. It's just income that you get just by holding something. Then we can talk about staking coins on the cryptocurrency side, which is kind of like REIT or dividend, but it's not, you're not buying stock into a company. You're just holding coins. You're just holding them, but they pay you for holding them. So once you start combining all these streams, your stream gets bigger and bigger and bigger. Maybe you can form a river, or a lake or something bigger like that. But yeah, so you want to Google the dividend stocks. Like again, they got the option monthly or quarterly. You can look for what you want to you want to wait every 3 months, or you want it every month. Got that option. Then you got the option of once you can decide what you want monthly or quarterly, then you just go to the company. You got to obviously buy shares of the company, and then just receive the dividend. Make sure it's before the X date, the 4 dates that we went through. See, but see, when the company pays them every month, you miss that month, you get it next month. When it's on a quarterly, meanwhile, you miss that month, you got to wait 3 more months. So that's very important if you're going to go on a quarterly. You don't want to buy stock just for the dividends and then miss the date when you get paid for the dividends. That defeats the whole purpose. So once again, as I always say, the hardest part of the market is not really doing the actual trading. It's the research and the homework behind the trade. That's the hardest part. But other than that, people, yeah, you want to just do your research. Like I keep saying, go to Google, stocks that pay in the month. Matter of fact, I got a couple of minutes. We can do this right now while I'm here. Get the screen share ready. All right, let's see. Pay monthly dividends. All right, this came up. That's a REIT right there. That's crazy. All right, now this is kind of what 6 months ago. But just scroll down. It tells you all kind of good stock. All right, so that's April. That's a little bit more recent. You know, hmm, June. Okay, here all 56 monthly dividend stocks. These are the five best apparently. It just tells you about the so what's the best one? What's number one? Let's go see what number one is. Royalty income. Ah, it's a REIT. Ah, see, highly impressive dividend history, which is unmatched along monthly. Well, let's see. I'm gonna have to go check this out myself. What is this again? Royalty income? Yeah, we're gonna check this one out ourselves. Wow, wow, $2.76 for what? Oh, okay. Well, pretty much, people. That's how I found. We're gonna look this out ourselves. Royalty income stock. See how much shares that is. You might. Yeah, that's how the research is done when you're looking for information on stocks. All right, it's $60 a share. I was gonna say for a dividend for it to be that high of amount. Okay. Yeah. All right, so there's more research I'm about to do myself. Go through there and look for now see that's like the pros and the cons. I'm glad I did that. Now, do you want to pay $60 a share to receive $2 back for the dividend? Now, for an upfront investment, that looks like you're not making your money. but you're in this for the longer term. And as you saw in that chart, well, I don't know if you saw it because I kind of breezed through it, but I saw it really quick that the dividend amount of that company was on a constant uptrend. You know, it was like as you saw, it was a line, a diagonal line up. So that's pretty much when you looking for dividends, man, you're looking at it like this: how much you want to invest up front to get on the back end. So if you figure you get $2 a month for 12 months, just one share, that's $24 a year off of one share. So it's just your cost analysis, how much you want to spend to how much you want to receive on the back end. And that was an extreme example. Like I say, but that's what you want to do when you look for dividend stocks. I don't know off the top of my head. I really don't deal with dividends. Like I say, I day trade. But looking at these, I think I'm gonna try some of these out. You know, just Google stocks that pay monthly dividends, stocks that pay quarterly dividends. You can get a mixture of both. You can do like I'm probably gonna do all monthly, but you switch it up. Some monthly, some quarterly. It'll give you a nice stream. You know, different times throughout the year. You know, you got a nice little windfall coming every 3 months. You know, you can start planning things around that windfall, I guess. I don't know, because like we always say that the goal is economic empowerment, man. Financial literacy, knowing how to spend your money, knowing how to move your money, knowing how to invest your money. And that's what it's about. Becoming your own boss. Because at the end of the day, nobody wants to work. Nobody wants to work. Everybody wants to be their own boss. But the funny thing about that is when you work for yourself, you actually do more work. Believe it or not, because you really can't call off because it's your business. All right, people. On that note, man, check out those couple stocks. What was it? KTOV, KTOV, and was it Isaiah, IZEA? They both gapped up. You know, they was kind of cheap. They both were like what 89 cents and 75 or something like that, and they both gapped to the dollar amount. You know, so on that note, man, remember, we gonna make it. We gonna make it. That's the motto for Trader Dog, man. We gonna make it. You know, like I said, man. Yesterday we did the REITs. Today we talked about dividend stocks. Tomorrow we're gonna do the next thing in this income streams. Talk about different income streams. You know what I mean? Beyond bosses, economic empowerment, starting your own businesses. Shit, even getting an extra job. Let me stop the music. See, there's nothing wrong if you got to get an extra job. Like it's me myself. I had to pick up a job. You know, this market moved against me and things. I'm trying to do so much with so many pies. So, but get the job. Just don't let the job overpower your dream, what you want to accomplish. That's the goal with it. When we talk about opening up income streams, because if you don't have no money to start with, obviously getting a job is going to be the first income stream. That's going to be the stream that's going to open up all your other income streams. So don't feel bad about working. It's just that don't let that job overpower your dreams to start your other, you know what I mean, your other streams. Like don't just work 40 50 60 70 hours a week for someone else, and when it's time to work for yourself, oh, I'm too tired. If that's the case, you're just gonna work 40 hours, 70 hours for someone else for 50 years out your life. You know, maybe that was how it was done back in the day, but now there's so many things done for people to make their own dreams, follow their own paths. So if you gotta work, man, you gotta work. There's nothing wrong with that. You know what I mean? That's you gotta do what you gotta do. Bills gotta get paid. Mouths gotta get fed. That that being said, don't just work for someone else and don't work for yourself. And that's what it's all about. I think that's what me I be trying to explain to people. That's what my man Tony Cannon be trying to explain to people. It's when you work for people. Yeah, you gotta work, but don't forget about yourself. Don't forget about your own LLC or your own corporation or your own partnership. Don't just work to make John 10 million a year. When it's coming for you, you always want, oh, I'm too tired. I gotta sleep in. Nah, that's not gonna work. You gotta hustle. Hustle plus muscle equals success. That's the motto at Trader Die. On that note, people, remember, man, we gonna make it. The music supposed to come in, but it didn't. Man, mess my whole scam up. I had the music playing and all. That was my little speech for the day. But yeah, man, just work for yourself. On that note, we out, man. Remember, we gonna make it.